Here's a question that could cost you over $100,000 in retirement. What's actually sitting in your retirement accounts right now? Not how much, but where is it? Because most Americans are making a massive mistake without even knowing it. They're putting all their eggs in one basket, and the IRS is rubbing its hands together, waiting. Look, I get it. You've been doing everything right. You've been maxing out that 401k, getting that employer match, watching the balance grow year after year. And it feels good, right? But here's what nobody tells you at those company retirement seminars. Having all your money in just one type of account is like playing poker with only one card. You've got no flexibility, no strategy, and when the IRS deals the next hand, you're stuck. Let me paint you a picture. Meet Sarah. She's 68. Retired last year with $1.2 million all in her traditional 401k. She thought she was set for life. Then the required minimum distributions kicked in. The IRS forced her to withdraw $48,000 in year one. That pushed her into a higher tax bracket, made 85% of her Social Security taxable, triggered extra Medicare charges. And here's the kicker, she didn't even need that money. Sarah's now paying $12,000 more in taxes every year than she has to. Over a 25-year retirement, that's $300,000 gone. And the worst part, it was completely avoidable. So, what's the answer? It's not about picking the perfect account. It's about building what financial pros call tax diversification, having the right mix of different account types working together. Think of it like having multiple tools in your toolbox. You don't use a hammer for every job, right? Today, I'm breaking down the 3-bucket system that could save you 6 figures in retirement and, more importantly, give you the freedom to actually enjoy those years. Let's dive in. This is where most Americans have everything. And look, it's a solid account. You get a tax break today. Your money grows without being taxed, and you pay taxes when you withdraw in retirement. The problem: the IRS has a ticking time bomb built into these accounts. It's called required minimum distributions, RMDs. Once you hit 73, the government says, time's up. Start taking money out whether you need it or not. And if you've been a great saver, those forced withdrawals can wreck your retirement plan. Here's the math. $1 million in a traditional 401k means about a $38,000 forced withdrawal. At age 73, $2 million. You're looking at $76,000 plus that you have to take and pay taxes on. That's not freedom. That's the IRS controlling your retirement. The smart move: have enough in traditional accounts to fill up those lower 10 to 12% tax brackets, but not so much that the RMDs push you into the 22% or 24% bracket. This is your freedom bucket, and I mean that literally. With a Roth, your money grows 100% tax-free. Your withdrawals in retirement, tax-free. No required minimum distributions. Ever. You control when and if you take money out. Let me show you why this matters. Let's say you're 70 and you need $15,000 for a new roof. If you pull it from your traditional 401k, that's $15,000 of taxable income. It could bump you into a higher bracket and trigger Medicare surcharges. But if you pull it from your Roth, zero tax impact. It's like it never happened. The Roth gives you something money can't buy: options. And in retirement, options equal control. Real-world example: my friend Tom retired at 62 with $400,000 in his Roth and $600,000 in his traditional IRA. From 60 to 70, he lived mostly off his taxable account while slowly converting chunks of his traditional IRA to Roth, staying in that sweet 12% tax bracket. By the time our RMDs kicked in at 73, his traditional balance was way smaller. His tax bill? Cut in half. That's the power of planning. This is the most underrated account in retirement planning. And honestly, it might be the most important one. Here's why. Total flexibility. No age restrictions. No withdrawal penalties. No forced distributions. Access your money anytime for anything. Think of this as your shock absorber. Your emergency fund on steroids. Your bridge to early retirement. Want to retire at 58? You need a taxable account because your 401k is locked until 59 and a half. Want to avoid selling stocks during a market crash? Your taxable account gives you cash to live on while your retirement accounts recover. Plus, here's a tax hack most people miss. Long-term capital gains are taxed at 0%, 15%, or 20%, often lower than your ordinary income tax rate. So a married couple can have up to $94,000 in income and pay 0 federal tax on long-term gains. That's huge. Your taxable account is the glue that holds your entire retirement strategy together. Okay. So what's the ideal split? Financial planners often talk about the 1/3 rule, roughly 1/3 in traditional accounts, 1/3 in Roth, and 1/3 in taxable. But here's what they don't tell you. This only matters if your portfolio is big enough. Let me explain. If you have under $150,000 total, tax diversification doesn't really move the needle. Your withdrawals will be small enough that you'll stay in low brackets anyway. Focus on growing your nest egg first. Between $250,000, $600,000, this is where it starts to matter. You'll want some Roth flexibility and maybe a small taxable cushion. $600K, $1.5 million. Tax diversification becomes a game changer. You could save $50,000, $100,000 over retirement with the right mix. Over $1.5 million. Tax planning isn't optional, it's critical. Poor planning here can cost you $200,000 plus over 30 years. So don't stress the perfect ratio if you're just starting out. Build your wealth first. Optimize the mix as you grow. Here's something that doesn't show up on spreadsheets but matters just as much. I can't tell you how many retirees I've talked to who feel guilty every time they withdraw from their 401k. They see that balance dropping and panic even when it's part of the plan. But when you have 3 buckets, you have a mental map. This account is for daily spending. This one's for emergencies. This one's for legacy. It sounds simple, but that clarity changes how you feel about retirement, and how you feel affects the decisions you make. Mistake number 1. Waiting until retirement to fix this. If you're in your 40s or 50s, you have time. If you're in your 70s, your options are limited. Start diversifying now, not when RMDs are already hitting. Mistake number 2. Ignoring the taxable account. Most high-income earners do this. They max out retirement accounts but never build a brokerage. Big mistake. That taxable account is your flexibility fund, and you can't buy flexibility later. Mistake number 3. Going all Roth when you're in a high tax bracket. Yes, Roth is powerful, but if you're paying 32% tax today to convert, and you'd only pay 22% in retirement, you're leaving money on the table. Balance matters. Mistake number 4. Not thinking about your heirs. If you leave your kids a $1 million traditional IRA, they'll owe taxes on every dollar. But a $1 million Roth, tax-free inheritance. Your account type affects your legacy. Let me boil this down for you. The goal isn't perfection, it's options. Traditional accounts give you tax deductions now and controlled withdrawals later. Roth accounts give you tax-free flexibility and no RMDs. Taxable accounts give you complete freedom at any age together. They give you control. Control over your taxes. Control over your spending. Control over your life in retirement. And that control is worth more than any perfect allocation formula. Your action steps this week. 1. Log into your accounts. Write down how much you have in traditional, Roth, and taxable. 2. Identify your gap. Are you 100% traditional? 100% Roth? No taxable at all? 3. Make one change. Shift some 401k contributions to Roth. Open a brokerage account. Start small but start. The best time to fix this was 10 years ago. The second best time, right now. If this video just saved you from a 6-figure tax mistake, do me a favor. Smash that like button so more people see this. Subscribe to Finance Flash for weekly money strategies that actually work. Drop a comment below. Which bucket are you working on building next? And hey, if you know someone who's retiring soon, or is all their money in a 401k, send them this video. It could literally change their retirement. I'm dropping a new video next week on how to do Roth conversions without triggering massive tax bills. You won't want to miss it. Thanks for watching. Let's build wealth the smart way. See you in the next one.